3, 2, 1.
You know, there's some weeks that there's nothing to talk about, and I gotta really work to find stuff to talk
This
about.
is not that week.
This is not that week.
I know it's not that.
Oh, Lee.
No, it's not this week. You're probably trying to figure out what stuff to not talk about.
100%.
Yeah.
I mean, this could be a 2-hour show. No, it's not gonna be. But there's so much going on. Yeah.
I can't sit still for 2 hours.
No, I don't want to talk about this stuff for 2 hours. I got other stuff I got to go back because by then something else will change.
For sure. So this is Friday.
It's 11 o'clock now.
Yeah.
Okay. So what happened today? 8:30 this morning, the jobs number comes out. 216,000 new jobs created in December versus the 175,000 that were expected. Okay. Yield immediately goes up, which means the price of bonds goes down. The stock market immediately goes down, right?
Yields go up, stock market tends to go down.
Yeah, when yields go up, at least that's what's been happening now, right?
Yeah.
The stocks and bonds are moving together. So when yield goes up, the price of the bond goes down.
Which is back asswards. It's not normally that way.
Yeah, I mean, we're living in an upside down world, but we've been here for a while. But the real upside down part of it is they expected 175,000 new jobs to be created, right? 216,000 jobs got created. How is that a bad thing, right? It's bad because it does not help the Fed to be able to lower rates if more jobs are getting created, right? The unemployment rate stayed the same, so unemployment's not going up. More jobs are getting created. It makes inflation, puts pressure on inflation to go higher, and does not let the Fed bring rates down, right? If anything, it would make the Fed push rates higher, right? Then that was at 8:30, and so at 9:30 market opens down a little bit. It had gone way down right after the announcement came out, but then it starts heading back up, and right now, I mean, I don't know, as of a couple of minutes ago, it was up like 0.5%, the S&P 500, right? So it went from being pretty like 0.5% negative to 0.5% positive by about 10:30. Why did that happen? The Institute for Supply Management. So the ISM number comes out, and it's a leading indicator for the economy. And there's plenty of leading indicators, which everybody has blown off up to this point, because all the leading indicators say we're going into recession in 2024, and no one's wanted to talk about that. There's a thing called LEI, which is I can't remember what the acronym means, but it's all the compilation of leading indicators. And it's been screaming recession for probably close to a year. But now all of a sudden they want to look at ISM because it was weaker, and it's showing that the economy is getting softer. And so therefore that's still, even though the jobs report was much stronger than expected, the weak ISM number is still going to be able to let the Fed lower rates. And so so the market rallies. They're doing everything they can to keep this rally going. It's hysterical.
Yeah, you can see a bunch of people in a room going, hold, hold.
It is. I don't know how you possibly keep your mind around this stuff unless you're looking at a chart. I just cannot even. I just can't figure out how anybody can keep this stuff straight. And then the other thing wasn't this morning. It was actually, I think the announcement came out this morning or last night. I don't know exactly how to pronounce this. Maersk, that the biggest shipping company in the world.
Yeah.
They came out with a statement that said all their ships are going around, around Africa, for the foreseeable future. They're not messing with the Houthis in the Red Sea for the foreseeable future. And so that you would think, and that happened last weekend, right? It's been going on, but you would think the price of oil would have started to come up by now, and oil has not come up, and if anything, it's down. And the U.S. is actually, one of the things I kind of was laughing at on Bloomberg this morning. Oil is basically flat to down, and they're saying because of U.S. supply is maintaining the stability. And I'm like, well, what do you mean? I thought we weren't drilling. I thought that was the whole, because we put that chart up like a week or two ago, right? I don't know how you keep your mind around this. It's all noise. It's all noise until it shows up in price on the chart.
Yeah. And that's the important takeaway. Like, we do talk about this stuff because, well, generally because everybody's talking about it.
Yeah.
But it is, macro and microeconomics is important. But as Jerry just pointed out, at the end of the day, price is what matters. Like, the price of the thing is what's the price of what someone's willing to pay for it, sell it and buy it.
Yep.
And that's the real price of it. Right?
Yeah.
Now, you can look at all these other factors to kind of try to give yourself some explanation as to why, but at the end of the day, does that matter that much? It really doesn't, particularly when you're managing your retirement account. It's nice to know why, but it doesn't really matter.
Yeah. What gets really hard is when because we see it we get questions in, or we see it in the Facebook group. People are like, well, when this person gets in, or when this person gets out, or when the war here or the war there, like when these things happen, then when X, then Y.
Yeah.
It just doesn't work that way.
Well, there's nothing wrong with an opinion.
No, it's when you
manage your retirement account
put
based
a bet on it.
Yeah, you're betting on it. That's what it is. It's gambling.
Yep.
But we talk about all these things because we like to explain how these things impact the TSP funds, which generally it's impacting the S&P is a big part of that, right? And so it gives some sort of context to why the C fund is doing something. And so that's really why we talk about this stuff. But it's important to remember at the end of the day, like a lot of my trading personally, I don't care. I have absolutely no interest what's going on.
Yep.
I only care what the chart's telling me at the given time.
Well, that's all I look at.
Yeah, yeah. I don't.
I like I was a political science major.
Yeah.
Like, I like all this stuff.
I do too. Yeah. we're both kind of social scientists.
Yep.
I was public administration, and that stuff's interesting.
Yep.
I like to know what's going on in current affairs. It doesn't drive my decisions too much when I'm actually moving money because it's just noise, right? And there's nothing wrong with listening to noise. It's like watching. For us, a lot of the times watching this finance stuff is like, what someone else may do when they're watching reality TV shows.
Pretty much.
Right? You know, it's all over the place. But at the end of the day, we're not letting that drive our decisions. We're gonna base our decisions on facts. What's happening, not what might happen. Now, we do take into consider what has happened. There's nothing wrong with looking at historical data.
Yeah.
Right? Nothing wrong with that at all. So want to make sure I don't get that, misconstrued. Not really into looking in the future. It's nice to be able to anticipate things, but generally speaking, I need a confirmation that something has happened and allows me to make a decision.
That's what happened this week. All indications, you're going into January really strong. Everybody's excited about the Santa Claus rally. The fourth year of the presidential election cycle is supposed to be super strong, especially when the incumbent president is in, and all that is very bullish for the market. And when you actually look at it on a chart, it rolled over in a big way on Monday or Tuesday, I guess was the first trading day of the year. And so, the backdrop is extremely bullish, and the 2024 might end up being an up year. That's great. But obviously this week was not helpful, and we're going to get to that actually a little bit here. We're going to get J.C. Pratt's perspective of what happened on the Santa Claus rally. So we'll talk about, we're getting a pay raise, and we got a raise in TSP contribution limits, so we'll take a look at that. Lance Roberts put out this really good post on January 3rd. It should look relatively familiar because we have similar, everybody looks at the same kind of indicators, and you guys will get the idea of that. JC's perspective of the Santa Claus rally, and that's probably going to be it the last time we talk about it for the year. And then TSP fund charts. So pay raise and new TSP contribution limits. So they finalized 2024 pay raise. So White House issues the executive order. Overall average raise is 5.2%. 24 GS schedules effective first day of the pay period, whatever the payroll cycle is in January. I don't have to worry about that anymore. If you're a retiree, I don't think that's in here, but I got it in the mail yesterday. If you're a retiree from FERS, I think the COLA was like 2.2%, and if you're CSRS, it was like 3.2%, which is something. It's not even close to inflation, but whatever. So across the board, 4.7 plus average 0.5% increase in locality pay. But the increase is the largest pay raise for the civilian federal employee population in more than 40 years. In 2023, the pay raise overall was 4.6%. Okay, so we get paid more in 2024, and we get to contribute more to TSP. So IRS comes out with cost of living adjustments affecting 24 maximum TSP contribution limits, as well as how much you can contribute to IRAs. So contribution limit for whether it's a 401k, 403b, TSP, goes up to 23,000 from 22,500. So so now when you figure out how much you're going to contribute, if you're trying to max out your TSP, you're dividing 23,000 by whatever 26 pay periods, and then catch up. So if you're over 50, it definitely gets better. It doesn't get better. Remains at 7,500. So the total now is 30,500. So if you are over 50, you can contribute 30,500 to your TSP in 2024. IRA increased $500 also. So now the IRA limit is 7,000, up from 6,500. It would be really good if they would drastically up that IRA contribution limit. I mean, it's really unfortunate that you have to be in a 401k type of structure. Anyway, yeah. Okay, so realinvestmentadvice.com. Lance Roberts does a great job with this company, and I would highly recommend you guys checking out his stuff. Definitely get on his email list. He's on Adam Taggart's new YouTube channel. It's called what's it called? Thoughtful Money. It used to be Wealthy On. Wealthy On got. I don't know if buying out Adam is. In fact, I know it's not the best term for it, but in fact, I was a little annoyed. I'm sort of boycotting Wealthy On because the new host did an interview the other day with the guy that came on that said he was the founder of Wealthy On, and I'm like, how do you get to say that you're the founder when for the past 2 years, Adam Taggart, the guy that actually founded it, ran the channel, hosted all these shows.
Yeah.
You guys, quote unquote, buy him out, again, which is not the term.
Yeah, they forced him
kick
out.
him out.
Yeah, they forced him out.
And now this knucklehead gets to say he's the founder.
Can you tell we're a little bitter? Yeah, it was a really good channel, and the guy put out a lot of really good information, and whatever happened in the background, made this happen. But, not to say that Wealthy On isn't still going to have some good content, but if you guys liked it, if you were, based on what we talk about all the time, then you can follow him over to YouTube. Yeah. And he also has a Substack. I don't know if any of you are not familiar with that. It's a sort of an app or a website that has, you can subscribe to these, generally just call them newsletters. It's kind of taking a few steps back. I'm not a huge fan of the platform per se, but if there's certain people that you really like and they're on there, it's a great way to get their stuff. I mean, I pay like $8 a month to get his. What I like about it is he puts his transcript. It's not even the transcript. He rewrites the entire episode. I don't necessarily always like to watch a video because I don't know what's in it. I can scroll through the word, through the copy and go, oh, that's interesting, and I'll read it. I know that's kind of, backwards to watching the video, but that's the way I do it because I don't want to sit there and watch an hour-long video and I don't know what's in it sometimes. Yeah, no, it's actually a really good way to do it because some of his videos get pretty long. I don't know how he does it because we would never have time to rewrite this. So don't ask. That's not going to happen here. He can't be a one-man show. He's got to be somebody writing that. Yeah, because it's painstaking. It's one thing to have a transcript. Right. That's easy. No, this is like notes. I mean, you can tell he's doing it. It comes out fast. Like, I know. Okay, so Lance puts out this this newsletter. So Lance and his partners, Mike Leibowitz,
And it's January 3rd, so it's kind of looking at what's happening to go forward into 2024. It's kind of like what we were just talking about. So first article of the year, January stats and New Year investing resolutions, whatever, provides a review of what we might expect in 24. It's a little unique, right? Because we get the upcoming presidential election. Will certainly be a critical factor driving markets. Election years tend to have better performance, which is true if you look at the chart. This occurs in part because the incumbent can take action to encourage investor enthusiasm. We've kind of talked about that a little bit. Does the Fed really want to lower rates because it will help stimulate the market and it's good for the incumbent? This occurs in part because the incumbent can take action to encourage investor enthusiasm. In turn, more robust markets improve consumer sentiment, which is good. The wealth effect. Such boosts the incumbent's chance of winning as well as those of their party in the House and Senate. So those are bullish things that should drive prices higher in 2024. So last week they talked about the market was very overbought. We've been talking about this here for a while. It's been overbought for weeks and deviated above moving averages. So a correction was likely. That correction started on Friday, so last Friday, and continued through yesterday. Now, he's putting this out Monday or Tuesday, whatever the third was. So, this isn't current because obviously the correction continued. But that correction started on Friday, continued through yesterday. Of note was the negative divergence between relative strength and the market as shown. We're going to show his chart in a second. How often do we talk about divergence between relative strength and price? That weakening of relative strength as the market rose was a warning sign for an eventual correction. The downside remains limited at the moment, and the selling pressure was mostly relegated to last year's best performers. So if you guys were watching, I think it was January 3rd, which was the second was the first trading day of the year. Apple was down 4%. If that's not a giant red flag, I don't know what is, but that's what he's talking about. Basically the Magnificent Seven tanked the first couple days of the year. The question is whether yesterday's rotation to healthcare and energy stocks is the beginning of a new trend or just a temporary stop before the tech chase resumes. So continue to hold cash. We think we'll have a better entry point to increase portfolio exposure in the next few days. So these guys aren't, CSI and F&G funds. That they kind of incrementally move into stocks or equities when conditions are good, and they'll go a little bit in, and that's why he's saying continue to hold extra cash, because we think as the market pulls back, he's going to get a better entry point, which is basically because he thinks that overall in 2024 the market goes higher, but right now it's pulling back. So look for a place where it finds support and then get in. That's the place to buy. So this is the chart he's talking about. MACD, RSI, and price. I mean, it's very similar to what we do. The layout that I use is different, but here we are. This is 2024. This came out on January 3rd, remember, so MACD turns negative, RSI is declining, right? So he uses MACD a lot as the trigger, but MACD is declining, and what he's talking about is price is moving higher, right, as RSI is moving lower. I don't remember if we pointed that out last week. I definitely have been talking about it in the newsletter here for a while. So I was looking, even though all the backdrop is bullish, I'm looking at this technically. We are much closer to a top in this scenario than we are to a bottom, right? We're looking for a reason to get out of the stock funds when things get overbought like this. That's a technical perspective, regardless of what all the news and the bullish bias going forward, which is still there. Okay. And also part of that newsletter was the tweet of the day, he said, which I thought was kind of interesting. So first quarter of an election year often exhibits a sluggish performance for the S&P 500, the first quarter. Okay. But as the year progresses, the market tends to regain strength, ultimately delivering a solid performance. So here we are. That's what the average of the first quarter of the election year from 1950 to 2023, on average, it's only gaining 0.2%. So first quarter tends to be really weak, but then as the year goes on, it starts picking up. Okay. All right, so Santa Claus Rally closeout. So this is from J.C. Peretz. I can't remember what day. It was some day this week. So he says, I can hear him saying this as I'm reading it, but Santa didn't show up this year for his annual Santa Claus Rally. Historically, that usually precedes some underwhelming years for the S&P 500. Okay, so if we don't get a Santa Claus Rally, S&P tends to be down, flat to down for the year. This is the first leg of the January trifecta. So the January trifecta is a stock trader's almanac indicator that's made up of, it's called a trifecta because it's got 3 indicators in there. The first one is a Santa Claus Rally. The second one is the first 5 days of January. And the third one is the January barometer, which is the closing price for January. So you get the Santa Claus Rally, first 5 days of January, and then the close for January. So all those 3 things combined is called the January barometer. Okay, so we know that the Santa Claus Rally failed. The average Santa Claus Rally is 1.3%. From the last 5 trading days of the year plus the first 2 trading days of the following year, the average Santa Claus Rally is 1.3%. This year, over that time period, the S&P lost 1.03%. It's a huge fail of the Santa Claus Rally. So the second thing is the first 5 days of January. As of this conversation, the first 5 days of January is going to be down. When we got on, the S&P 500 was up about 0.5%. It would have to be up over 1% today. It would have to close over 1% to be flat because it's been down pretty hard the last 3 days. So in all likelihood, the first 5 days is going to fail. And there's all kinds of stats about, well, what if Santa Claus Rally fails, but the first 5 days are positive and the January total for January is positive? There's all kinds of stats about all this, but it gets worse. If the Santa Claus Rally fails, the tendency for the year gets worse. If the Santa Claus Rally plus the first 5 days of January fails, it gets worse more. And then if the January barometer, the whole trifecta fails, generally the year is not good. Again, that flies in the face of it's the fourth, the presidential cycle. So these are all crystal balls, is how I look at this. All this stuff is people trying to use historical data to extrapolate what's going to happen going forward, which is fine. It's a guide. But at the end of the day, the technical indicators are the thing for me that, because that's what's actually happening in real time. Okay. So when he wrote this, does the S&P 500 put in a positive 5 days of the year? The answer is probably no. As January goes, so goes the rest of the year is how I learned it. And that's a pretty, everybody's learned it that way. As January goes, so goes the year. And so they're going to continue to monitor the trifecta and see what happens. But this was, I put this in bold because the important thing here is that he said, let's reiterate, the S&P 500 did not rally during a seasonally strong period known as the Santa Claus Rally. So it was supposed to rally and it didn't. That's telling you something. Something is happening, right? If there's no other takeaway, that's a good one. It's supposed to be rallying, and it didn't. And while this indicator is normally reserved for the S&P 500, I wanted to widen it out to other equities to get a broader look. So I thought this is pretty interesting. This is the Santa Claus Rally period for this year. Okay. So IWM is small caps. It's not exactly our S fund, but our S fund tanked during that rally period. Okay. The NASDAQ is tech, tanked during that rally period. iFund is EFA, tanked. SPY, tanked, down 1.03%. RSP is equal weighted S&P, not as bad. IOO is world top 100, not too bad. As you go up this, right, it's either it failed the least or it actually did well during the Santa Claus rally. So, what is FXI? You know what FXI is? FXI is the China index. So I think it was last week we were talking about the new iFund.
Yeah.
And how it's going to be ex-China, ex-Hong Kong,
ex-everything.
ex-US, ex-everything, right? During the Santa Claus rally, and all these people that we shouldn't, obviously, I mean, unless you're a member of Congress, you understand that you can't not buy things made in China because everything we have basically is made in China. And so to say that you're not contributing, the whole thing is stupid.
To say you're not contributing to their economy is, you got to be just blind.
It's insane.
Yeah.
We buy their stuff.
It's unfortunate.
Well, we don't produce stuff anymore, so we buy their stuff, right?
Yeah.
Okay. So the point is, China has been what tends to happen is things rotate, right? And they go in cycles, and China has been way down. So in my personally, I watch FXI a lot because it's way undervalued versus the S&P 500 right now, and it's the one that was up 2.69% during that Santa Claus rally. China is probably going to have a really good year. Exactly in the year that now China wasn't in the EFA anyway. It wasn't in the iFund, but we should have included China from a let's make money in TSP perspective.
Right. Not from a political perspective or anything.
Right.
Set all that stuff aside. We're talking about making money. Yeah, I mean they expanded the countries and the whole the offerings, the assets that within that in the new index. So that is better, right? So it's broader, but to leave out a few that are actually
the second biggest economy in the world,
that are actually working.
you should leave that one out.
Yeah, let's leave that one out. You see where we sit on this discussion.
Anyway, all right, TSP fund charts. So here's a chart. This is the C Fund Weekly, right? We do this every week. This is a little bit different take of it. I took stripped everything away. We got 3 lines there. So this is the top in 2022, January 2022. We came back and hit that top almost to the tick, right? We didn't quite get above it, that 4,800 level, but for all intents and purposes, we hit it. And then this week rolled over. Now, again, this is as of Friday morning, so if we get a little bit of a recovery on Friday, this red candle will look a little bit different. But as of right now, we hit resistance at the top there at about 4,800. And what's interesting is that candle right there. So last week, it's called an island reversal pattern. Okay. So if you can see, I wish I could zoom in on this, but where the market closed the week before, it gapped up. It gapped up into this week. Okay. Did that week, reversed, right? Hit that 47.96, reversed, closed a little bit up for the week, but at the bottom of the trading range. And then this week, gapped down at the open. So you have a gap on the left and a gap on the right on a reversal week. It's called an island reversal. It is extremely bearish. Extremely bearish. And so when you see an island reversal, this is a weekly pattern, so you're going to take a hit, but this is the first indicator that the island reversal is in place, and then next week would be the confirmation. So if you're actually trading this in whether it's TSP or a brokerage account or whatever, this is your action week that confirms the island reversal pattern, and the idea is that it goes lower from there. So that's like if you were looking at an island reversal. The reason I got these 3 lines in here is that as of where we are this week's close, it's not closed yet again, but it's below that week. Okay. So in the short term, we have a lower low, right? We took out that low. That's not good. In an uptrend, you want higher highs and higher lows. So right now, we have a lower low. That's not good. The next one is this 4,600 level. We've been talking about the 4,600 level forever. This was a big deal when it gapped through there, right? Because it was resistance there, resistance there. That's where the breakdown happened back in January of 2022. So that 4,600 level is a big deal. So if the market keeps going down, it might take some time to get there. But if it gets to 4,600 and that support level fails, that's a problem. If it doesn't fail, which it shouldn't, right? Because 2024 is supposed to be a bullish year. So let's say we come down here like this. This would be a great place to find support, and the market keeps moving higher. So this would actually kind of be my base case, that something like that would happen. Okay. So that's the support resistance line perspective. Okay. If we do the same chart and do a Fibonacci retracement, and so this line here is just a long-term trend line. So all I did was connect, basically the lows. And so as long as we don't get below that line, the overall trend is up. Okay, if it breaks that black line, it's a much bigger problem, right? You've already lost on a percentage basis. If you come down here, you're down quite a bit. But if it breaks this line, if we get down here, we're probably testing these lows. So the other thing was the Fibonacci retracement level. So what's a reasonable, what are some lines in the sand that I could look at? So this was a pretty important low down here. And all I did was take a Fibonacci retracement level from that low to the high right here. So the first level of pullback should be the 38% retracement level. So 4,500, let's say. Right? So from a Fibonacci perspective, if we get below 4,500, we're probably down here at 4,300. But again, I didn't want to do it all in the same chart because it gets really messy. But really, the 4,600 level, right? This is our first support target. And then on the Fibonacci, we're down here, somewhere between in here and here. So there's a lot to look at. At the end of the day, as long as we stay above this line, then the trend is still up in the long-term trend. Again, it depends on how you're managing your TSP account. Okay. Anything else you think on that one? I don't think so.
No, I think that's a really good. Go back for just a second,
Yep.
but I think it's a really good chart because this is, and for those that maybe are new to watching us, this is why I say this. But those of you who've been watching us for a while, you know this. So what Jerry did there, and even if you take away the Fibonacci, and you just draw that trend line, right? And let's say you had a moving average in there, right? Those simple things can really help you manage your account through a year. Just throughout a year, if once a week, this is a weekly chart?
Yep, weekly chart.
Once a week, you take a look at this. You go, oh, my goodness, it's getting close to that line. Oh, my goodness, it went through that line. Let me get out.
Yep.
And then you wait, cross back up through, you get back in. These are going to be time periods that are going to be weeks apart. So you're not going to have to worry about your 2 moves a month. You're going to be within that window. Right. That's generally the way they designed this. Now, we try to we squeeze all the juice out we can, right? So that's how we do it. And we want to try to get, but if we wouldn't want to take that loss from where it is right now down to that line, right? That the trend line. We wouldn't want to. Right. But that's not to say that would be a reason that would be horrible if you did. No. It's going to sting a little. It's going to feel a little. But you know what? If it bounces back up, you're still long term.
Yeah, long term, the trend is up.
The trend is still up. It goes through that line. The trend has significantly changed. Yeah. It's not. It's going bear. So, but the takeaway here is, you can manage your account very simply using these. You don't have to get into all the crazy indicators that we talk about. And a lot of times, I will actually just turn everything off, and go back to a trend line or a moving average and just start there and get my head wrapped around it. Because sometimes it can just get so much noise. And at some point, there's too many indicators, right? Like Jerry was saying, he doesn't want to put all that stuff at once because it just starts to go crazy. You could see some of these people that are in technical analysis, and they'll put out a chart, and it looks like a Christmas tree threw up on it.
Yeah.
You're just like,
Yeah.
I don't even know what's going on here.
Yeah.
Nobody wants to see that stuff unless you're really into it.
Yeah.
And so I like to actually back up a little bit, make it clean, nice and neat, and then make your decisions. So those of you watching this that are like, oh my God, how could I ever do this? I don't even know how to spell Fibonacci, whatever. You don't need to do all that to manage a long term. Again, we're talking about a retirement account. We're not talking about your brokerage account. You may want to manage that a different way. But a retirement account that you're going to be in for 10, 20, 30 years, that is an easy way to do it. Now, you're going to take some losses because you'll see right there. I mean, that's in our mind, that would be a significant loss just to ride that down to the line. Yep. And God forbid it goes through the line. Then you get out. But it's not the end of the world.
Yeah, you want to be on the right side of the trend. And so people are always like, well, kind of what does that mean? If you're looking at this, the trend line, the trend is up. So if you're on a weekly basis and you want to be on the right side of the trend, you're on it.
You're fine.
Yeah.
You're fine. You're going to take some losses.
Drawdowns, right?
Not losses. You're going to take, losses and gains are not a great word for a retirement account. And we end up using them because it is what the larger world uses, those kind of things. But you're really not. Go back if you're in our Facebook group, you can go back and look at a video that we did that's called Locking in Your Losses and the Fallacy of a Paper Loss. Yeah. Some of those will help you wrap your mind around. It really drives me crazy when I see people that have really been trying to manage their TSP account for years. Like they're obviously actively engaged with it. And they still say, oh, you know what? I'm buying shares cheap. Yeah. Only with new money. Now, if you got a lot of new money going in there, good for you. But probably, especially been doing this a while, your larger pot of money is the one that's already in there, and that's not buying anything.
Right.
It's just being moved back and forth, which means you leave it at one price and go put it at this price, whatever. You're not buying anything.
Right.
And so, but I look at that and I'm like, how can this person who is obviously, really trying to misses that point? But it's because we don't know any better. A lot of times we just listen to the narrative of Bloomberg just know that when you're watching financial news, they're not talking about retirement accounts.
I don't even feel like people listen to Bloomberg. Like what we're talking about, like government employees and stuff. I don't think people listen to Bloomberg. I think they listen to their friends that are saying buy stocks cheap. I'm like,
well, so what it is 1 out of 20 of your friends watches Bloomberg.
Yeah,
and they get the conversation going. Absolutely, yeah. I mean, if you go back to when we were doing this in the Gov years ago, that's exactly how it would happen. Back when we had water coolers and back when we had, a coffee machine everybody went to, I always heard the discussions there. And I'd be like, well, where'd you hear that? Oh, so-and-so told me. Yeah. Oh, you didn't get that from a reputable news source? I don't want to hear
the circular reporting is nonstop.
Yeah. All right. We beat that to death. What's that next slide? Oh. Yeah. If you want to get more of this, go check out our website. Other than that, if you have any questions, shoot your questions to... in the comments section. Wherever you find the video, put them in the comments section. That's the easiest way for us to see them. We won't see them immediately, but we will go see them. Yep. And if there is no comment section, you can always shoot us a question at support@growmytsp.com. The support team will forward it to us, and we'll get to it. We might even talk about it on the show.
We do that sometimes.
Absolutely. Hope you guys are having a great start to your new year. We've got some exciting things going on in Grow My TSP. Yep. We're getting ready to add a lot of things to our website, free and paid. So stay tuned in, guys. It's going to be a great year. Yep. All right. I hope it's a great year for you. Take care, everybody.
Out of here.